Welcome back. This is Draxxts, the co-founder for the Famous Fox Federation. And in this video, I'm going to be covering the ins and outs of NFT lending as a whole and what that could mean for you as either a potential lender or a potential borrower. Non-fungible tokens, or NFTs, have become a valid asset class recently. The NFT market has introduced a growing vertical, NFT lending. In this video, you'll learn about the fundamentals of NFT lending, including an introduction to this concept, why we need it, how you can benefit from it, and why it's important for the development of the NFT space. So let's start off with what is NFT lending. NFT lending allows the holder of an NFT to use it as collateral against a loan. It allows the holder of the NFT to borrow money and the lender to earn interest. If the loan ends up defaulting, the lender is then compensated with the NFT. NFT lending terms can be created from either the lender side or the borrower side, and the lender can generally make terms to accept with any NFT within a collection for specific terms. Most likely, these will be floor NFTs that end up accepting those terms, but you do have cases where, folks with rarer NFTs can also take those terms. And borrowers can also list their NFT as collateral, for example, on our lending platform Citrus, and they can set their own required loan terms. Once a lender and borrower agree on those terms, the NFT is either frozen or escrowed automatically, depending on the lending platform's smart contract. The funds of the loan are automatically deducted from the lender's wallet and transferred to the borrower's. If the loan is repaid within those specific terms, the NFT is automatically returned to the original owner. In the case the lender fails to repay the loan, the NFT is then transferred to the lender. There are many reasons to borrow money against your NFT. From the borrower's perspective, obviously NFT lending is all about liquidity. But why wouldn't a borrower simply sell his NFT to get liquidity instead of taking a loan against them? There are several reasons for that question. As a non-fungible token, a particular NFT may have an intrinsic value to its owner. In selling the NFT, the owner might fail in the future to repurchase that same exact NFT. NFTs, just like houses and cars, can have ongoing utility. Thus, putting them as collateral allows the holder to keep using it, for example. The borrower can still use the NFT as their PFP. They could even get future airdrops, and in many cases, the NFTs serve as a membership token for access to a community. Once you sell your NFT, you're no longer part of this community and you can lose the benefits within it. The NFT may be worth more than the liquidity the holder needs. So by using NFTs to take a loan, a holder can just ask for the right amount of SOL that they need at the moment without risking losing their NFT for good. Therefore, NFT lending is an easy way for the borrower to gain liquidity, and so far, this is mainly being presented from the reasons on the borrower's side. So let's talk about why NFT lending also makes sense from a lender's perspective. A lender would provide a loan to gain a return on his liquidity to expand their current diversification options within the decentralized finance space, or DeFi. One may lend against an NFT for several reasons. NFT lending is simple, unlike other lending opportunities. Lending against NFTs is fairly accessible thanks to smart contracts. Anyone with available funds can provide a loan with clear terms and transparent and traceable collateral. Claiming the collateral, in the case of a defaulted loan, is also much more trouble-free, unlike in regular financial markets. There's no intermediaries, for an example, including lawyers, administrators, etc., to settle breaches or defaults. Smart contracts make the lending operation automated and immutable. Now let's talk about how to get started. So in order to get started with borrowing or lending against the NFTs, there's a few more things you want to take into account. Choosing the right platform, evaluating the price of the NFT, and deciding on proper loan terms. For the platform, we recommend Citrus, brought to you by the Famous Fox Federation, a Solana-based NFT project. It can be found at citrus.famousfoxes.com. The most important factor in your decision should be the security of the platform you use, as NFT lending is based on rather new technology. Unlike crypto assets, NFTs are non-fungible, so each has its own unique value and there's no clear pricing for NFTs. However, there are several factors you'll have to consider, such as current floor price, how volatile the price action has been for the collection over its history and recently, as well as the price action and trend for Solana, which can impact the volatility of NFT pricing. You want to assess these risks when creating or accepting loan terms, including principal amount, duration, and interest. Let's touch on a few points for creating loan terms. As a lender, if you would not be interested in owning the NFT if it defaults, it might make sense to avoid creating a loan for it. If you're bearish on the price action of that NFT or bullish on the price of Solana, which might cause the floor price to go down on that collection, you'll either want to avoid creating a loan for that NFT or create an offer with a lower LTV or loan to value ratio. You can also minimize your exposure to these collections by setting shorter terms such as 3 or 5 day terms. However, borrowers might be less willing to take shorter term loans. If you're bullish on the price action of an NFT or bearish on the price action of Solana, which has the chance to cause the floor price of that collection to go up, then you can create terms that are more favorable for the borrower, such as offering a higher LTV or creating a loan with a longer duration. If you're uncertain about the price action for an NFT, it's best to avoid offering a loan on that collection. The other really important set of terms for an NFT loan include the APY or annual percentage yield and duration. As a general rule, the less risky the price action is of an NFT, or the less time you're exposed to the price action of that NFT, using a lower APY is more acceptable. The opposite is also true, where the more risky the price action is, or the longer you're exposed to the price action of an NFT, using a higher APY is more acceptable. As a borrower, you'll have to think, how much money do you need and how much you are willing to risk your collateral NFTs for it? As a lender, you'll have to think how much money you're willing to give and for how long. Of course, your terms must meet the terms of the other side so the deal can be reasonable. The bottom line, NFT lending makes a simple opportunity for borrowers to access liquidity and for lenders to earn a return on their funds. To take advantage of this opportunity wisely, make sure you make informed decisions with regard to deciding the loan terms and evaluating the NFT price. If you would like more specific information about creating loan offers or borrowing against your Solana NFTs, be sure to check out our other videos on our channel. And don't forget to check out our lending platform at citrus.famousfoxes.com. Happy lending.